Let's move on to the next topic. What should contractors be cautious about? And this kind of rolls into the next topic I wanted to talk about, which is how can contractors protect themselves so they don't lose everything, their mortgage or their kids' college education, right? So, what do contractors need to be cautious about, and what do they really need to understand about finance lending that will protect them?
Yeah, no, it's a great question. So having that plan is the most
Sure.
important starting point. Where do I want to get to? How am I going to get there, and what do I need to do it, right? So when you look at finance in particular, there's factors to consider that are project specific, and then there's financial factors of those finance options, different metrics that you need to consider. And then there's business scenarios that you need to consider. But I'll start with project specific, right? So um, I've got my capital options. I've got cash. I've got a line of credit. I've got credit cards. I've got alternative financing, construction specific like build, and I've got some other call you today, get money today type options that are
Okay.
not as great, right? But let's just say I have all of those available. What I see happen most is folks will use their most flexible options first, right? And their least flexible options because they've struggled to put a process in place around when to use which option and make it uniform across the business. They go with the most flexible ones because that's a read and react. I can do that, right? Or I can get to a point to operate off that. When if you're right sizing all of your options, you should flip that. You should use your less flexible options first, but use them for what they should be used for. And you protect your more flexible options like your line of credit and your cash. That's how you go from 3 to 4 weeks of liquid capital to 3 to 4 months, right? But why is that hard for contractors? The same way it probably is for you to try to get someone to put an operational practice in place. Well, the office doesn't want to talk to the field, or the field doesn't want to talk to the office. Great. I'm here for that conversation. But if you want to flip it and say, build's a great example, material financing is a great example. There's constraints on that product as far as how it's supposed to be used. So you can't use it necessarily reactively, or at least the best option is proactively. So does my estimating team, my back office team, my strategic finance person, CFO, controller, what have you, does my field team, do all of those people and departments know when to use material financing and when not to, right? And you can apply that to any of your capital options. And do they talk to each other, right? Because that's the key to having those processes in place. Because if you're one of those silos and you're making finance decisions or product decisions or whatever in a vacuum or in a silo, everything's a cost because you're not seeing the ROI or communicating, across the whole business why we do it this way. And so, long story there, but project specific factors to consider: complexity of the project, predictability. Is this the type of work that you do all the time? Is this a GC or client that you're very, very familiar with? Or is this a new out of town person and this is my first multifamily job or my first civil job and I do multifamily buildings, right? Time of the year, project schedule, payment terms in your contract, who else is involved, reputation. These are all project, specific factors to consider because if you want to put those processes in place in the business of when to use which capital options, you got to remove as much unpredictability from everything as you can. And then financial factors to consider: what are the terms of the money? What's the interest rate of the money? How flexible is it? Which I just spoke to, right? Is it fairly flexible? And then is it priced accordingly to the flexibility? And then covenants in place of your other options, eligible borrowing base, how that's affected by what else is going on in the business, right? So, the most common covenants on lines of credit for subcontractors: 75 to 80% available of your outstanding receivables. Well, if I'm in Chicago, I'm doing almost all my work, and in May to October, right? Well, what does that mean to my receivables and what I'm billing through the winter? How do I carry my overhead costs? How do I account for that, right? And so your eligible borrowing base, your $1 million line of credit, it's not really $1 million, right? And then any AR past 60 or 90 days, the bank excludes from your line. So most subs that are growing or high volume subs, sub 10% net profit margin. So basically every time I start a job, I'm cash flowing it and bankrolling it till I'm about 30 to 40% of the way through. I'm cash flow neutral at that point, which means if things hit the fan and I had to walk away tomorrow, I didn't lose any money, but I definitely didn't make any. But then when all's said and done, I could be waiting for that profit however long it takes to get my retainage, right? And so every time I start a job, I'm putting myself further behind the eight ball. Every subcontractor would have a lot of money coming to them over the next 2 years if they all stopped taking on new work, right? And so the financial factors to consider: the terms, the interest, the flexibility, and then how it affects your other capital options, how they work together.
Good. All right. Now, if somebody needed to put together a plan, that's something that obviously you help them with. Is that correct?
Yeah, there's two different parts to it, right? There's a traditional plan that you can look at and say, I want to grow, but I want to get to I'm only top line focused, or I'm only bottom line focused, or I was top line focused last year, now I'm bottom line focused, right? So there's metrics in the business that you would track differently based on whatever the overall goal of the business is, right? I had a client, for the past 2.5 years, mechanical space, about 28 million. And when we met 2 years ago, he had told me, yeah, we've been primarily new construction for the last 15 years. And service was less than 5% of our business. And he said, over the next year or two, we're going to try to grow service to 30 to 40% of our business. Wow. That is a huge jump for a $28 million contractor to pick that up. And at the time, I just made the assumption service is faster turns on your cash. Service is gonna be a better cash conversion cycle. You take the funds from the service side of the business, you move it on over to the new construction, so you can take on larger projects, more projects, not have to bankroll them all yourself. So you increase your top line on one side, and you insulate your risk and your cash on the service side, on the other side. So that was the conversation I had with him at the time. Lo and behold, we're 2.5, almost 3 years later now, and just got the announcement recently that they were acquired. Right. So when you look at multipliers in the construction space, there's been an increase of private equity groups buying contractors over the last 5 years. And so when you look at valuations of businesses, the multipliers for a business that has a service side, repeatable recurring revenue, faster turns on the cash, long-term agreements, right? 5-year maintenance agreement is worth it's worth a very different amount than a new construction build. So lo and behold, they did increase their service side dramatically over the last 3 to 4 years. And, that helped with their valuation. That helped with the multiplier they were able to get when they were acquired. So, yeah.
It's good. It's good to tell stories. It really puts a lot of this topic into perspective. But Travis, I think we hit this topic pretty hard the past 25 or so minutes. I mean, is there anything else you want to add? Any last tips you want to give to some contractors about financial lending?
Yeah, scenarios where financing might not be the best option, right? It might not be for everybody. And that's okay, but you want to recognize it, and you want to be in a position to review something and say, this is great, but maybe not right now, or this would make my problem worse, right? And so some scenarios where financing might not be the best option. Variable cost. So it makes it very difficult to plan for something if the cost of it can change and you're using it reactively. So I take out something for 30 days, for example, I pay it back within 30, it's this rate. But if it hits day 31, it's an escalated rate, right? And so variable cost financing is difficult to manage. Crutch usage. So avoid using financing, if you plan on using it as a crutch to cover up other financial mismanagement or poor planning, right? It's a strategic tool that you need to have plans and processes for to manage cash flow proactively, not reactively. I talked about this one earlier, using your financing in order of price instead of flexibility, right? Flexibility, when done correctly and processes are put in place, is more valuable to you than using the cheapest option overall, if you're being proactive. If you're being reactive and you're just constantly defending and putting out fires, then you're going to go with the cheapest option because you're not planning for it. You don't have a process, so you're not utilizing your options to your advantage. Predatory loans or options that are, what we consider bad debt. Subs generally are adverse to debt and finance in general, just from a mindset perspective. And we could do a whole session on why I think that is. But subs generally know that, avoid predatory payday loans or MCAs, merchant cash advances, if you can, because the interest rates are so high, right? Those are the ones that, you call them in the morning, you can have $100,000 that afternoon, but over the next 6 months, you're going to pay them back $200,000, and so it's a very short-term reaction to make sure you make payroll for the next couple of weeks, and then it can quickly get out of hand. And so just reviewing those options as an absolute last resort. And then, super low margin work. And there's been a few posts recently about this, but if you get into the low bid game, financing is not your main concern. There are so many other parts of the business that are going to suffer because you get into the low bid game as a subcontractor. And so, you get into that game and something goes wrong or a delay or whatever. Using financing in those situations when it's already too late and definitely wasn't planned for can only make those projects end up incurring a larger loss potentially, right? And so that's not specific to finance. There's a whole myriad of reasons on why the race to the bottom for subs is what works against the subcontractor community as a whole.
Yeah. Yeah, if you're bidding work with low margins, it's probably because when you're negotiating, you're taking money out of your profit rather than renegotiating scope. It's very important that contractors should never do that. Your profit is your profit. You need to keep that profit. So you don't negotiate profit, you negotiate scope. It's a give and take game. Well, Travis, this is all I got. How can people find you and get a hold of you if they need your assistance?
Yeah, Travis Mayer, Mayor, Travis at build.com, BILLD.com. The email, you can find me on LinkedIn. You'll probably see my name on a Jerry post here and there, so shouldn't be too hard to find. But we have at Build we have you mentioned this earlier, Jerry, but we have a cash flow analysis tool. It's a proprietary tool we developed in-house. We run subs through it all the time. It's a great tool to overlay with your standard business plan. Very consultative in nature, and there's no charge for that, right? We'll take a look at what you have going on, how money moves through the business currently, but more importantly, how money moves through the business based on where you want to get to. And so I'd highly recommend folks that are on their growth journey as an entrepreneur in the construction space. Take advantage of the resources around you. That's one of them.
Absolutely.
Jerry has resources. Everybody has resources. And if you think that you're doing something alone and this isn't happening to anybody else, I've had thousands of conversations, as Jerry has over the years. It's very few and far between where we come across something that we haven't seen before, and the resources are available. So right. If you've got a destination of where you want to get to, I highly recommend utilizing the resources, peer groups around you, and making it a team effort within the subcontractor community, and operate the way that other folks in our industry do.
In addition to the one-on-one contact, both Build and even my website, we have tons of free resources, videos with blogs and articles, and all different kinds of templates that anybody could have access to. I mean, I'm going to be on Bill's website pretty soon, and you're going to be on my website pretty soon. So I'm Jerry Aliberti, owner of Pro-Accel. If you haven't subscribed yet, please subscribe to my channel, like it, comment, ask Travis any questions in the comments, and I'll be sure to forward that to him as well, and leave your contact information as well so we can contact you. So again, Jerry Aliberti, Travis Mayer, and we'll see you on the next episode.